All right, we've made it. So why don't we get started? So first of all, do apologize. Things are a little bit different today. We've had a glass door incident in the office. We have glass doors on our conference rooms and one fell off. So now they're not letting us close the glass doors anymore. I think they're fearful that one's going to fall on an employee. So the door's open, but I've closed the curtain, but there could be a little bit of background noise. So I do apologize for that. But anyway, we'll get started. So I'm Mark Lamonica. I look after the individual investor business for Morningstar here in Australia. And today we are going to do our second webinar of the year. We're going to talk about building a portfolio. So we're going to focus on asset allocation. Then we're also going to pivot and talk about a couple opportunities that there are in the market right now. But of course, if anyone would like to listen to our podcast, we've got our 2023 State of the Market one out now. And of course, you can follow us on Instagram. So a comment from Lisa saying, so should we look forward to the end of the glass ceiling as well? Yes. I think maybe that is a sign. The door falling off is a sign that glass doors are in trouble as well as the glass ceiling. But before we get started, just the general advice warning. So anything you hear today is general advice. I don't know anything about you. I can't offer personal advice. For those of you that are over in New Zealand, you can get a copy of our FAP on our website, morningstar.com.au. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you would like personal advice. But of course, I would love questions. So if you have any questions as we go through this, then please feel free to send those through on the chat or in the Q&A. Sorry, I didn't get to all of them on last Tuesday. But then, of course, you can always email me at mark.lamonica1@morningstar.com if you have any questions. All right, so let's get started. So as I said, we're talking about asset allocation and opportunities. So let's go back and revisit something that we covered during last week's webinar. So we talked about New Year's resolutions, and we specifically talked about how important it is to think about goals and goal achievement anytime you're going through an investment process. And we talked about how that's really the structure and the framework that you can wrap around any decisions you make around investing. And we're going to continue that talk today. And once again, just as a very quick reminder, when we are setting goals and when we're starting to think about translating those goals into a portfolio, we really want to focus on risk capacity. So risk capacity, of course, is how much risk you need to take on in order to achieve your goals. That's really what we're going to start today and how that translates into building a portfolio. And we are going to talk about opportunities at the end, and I'll talk about a recent report that we just came out that, of course, if anyone needs, they can find it on our website, the Morningstar Investor website, or, of course, email me and I can send you a copy. But that report talks about opportunities, but we want to make sure that when we're thinking about our portfolio, once again, that we have that framework and that structure. And many people like to jump into, and I do as well, right? Like to jump into the end of the process. And that's finding those opportunities. What's that great share or ETF or whatever else that I'm going to buy that is going to, that's going to help me achieve my goals. But we really want to emphasize that there are a lot of other important parts that go into achieving your goals. And one of them is asset allocation. We want to talk about how that risk capacity, the amount of risk you need to take on in order to achieve your goal, how that naturally leads you into thinking about decision-making around asset allocation. So let's start pretty basic. At the end of the day, what are we doing as investors? Well, we're really exchanging risk for reward. So when we talk about risk from purely an investment standpoint, not necessarily from the risk that you and I face as investors, which is goal achievement, but purely from an investment standpoint, we're thinking about risk in terms of volatility. So when you hear riskiness of markets, that's what people are talking about. How much does the market and how much does each asset class bounce around in value? And that's really the way we define risk. And what we want to do as investors is we want to harness that risk to get a reward. And the reward is, of course, is long-term returns. We always want to focus on the long term because anything can happen over a short period of time, over an individual year or month or week or however you want to define it in the market. We really want to focus on the long term. And the example, and we used this last week as well, so I'll go through this quickly, is the more risk we take on, economic theory, investing theory tells us the more long-term reward we should get. So if we as investors can withstand that short-term volatility, we should get the payoff over the long term, which basically means that you need to take on enough risk. Once again, that risk capacity, you need to take on enough risk in order to get the return that's needed to achieve your goals. And obviously you should know what that is. And that's where we focused last week. So let's use two, very different examples on both ends of the spectrum of risk. So of course there's cash. And as we said last week, cash has no volatility. Cash does not bounce around in value. There's all sorts of mechanisms in place to make sure it does not bounce around in value, right? Everything from banks and how regulated a bank is to government guarantees of deposits. So there's all sorts of mechanisms saying that cash will not bounce around from a volatility standpoint. But of course, as we all know, that you are rewarded very little for holding cash. Then on the other end of the spectrum, there are, of course, shares. And we know shares can bounce around a fair amount in value. And we saw that last year. So a lot of volatility last year. So a lot of, and even over the course of the year, while it was a negative year for most stock markets around the world, including Australia, not as bad in Australia as it was in the US, for example, but we do have that volatility. And we saw over the course of last year a lot of big dips and a lot of rallies and all sorts of stuff happening. But it's that volatility, once again, that you were getting rewarded for. So over the long term, you should, of course, get higher expected returns from shares than you would for something like cash. And then there's all sorts of different asset classes that are in between. So we want to make sure we're taking on enough risk to get that return we need to achieve our goal. So we're going to take two examples. We're going to use a couple more technical investing definitions today, but it's illustrative and also important, I think, as you go through and think about that volatility. We're going to use two different ETFs as an example. So, of course, we all know returns. And the two ETFs we're using, Beta Shares, Australian High Interest Cash ETF, ticker symbol AAA. I put in that 5-year annual return that we got from that. So 1.37%, not very high, of course, especially when we sit there in an environment now where we're seeing inflation in Australia, not quite as high as other places, but still inflation getting into that 7% range. That's a really bad return. Then we're going to look at the most popular ETF in Australia, the Vanguard Australian Shares ETF. So ticker symbol VAS. And you can see over 5 years, we got just under a 10% return. Now, why are we getting a higher return? Well, we're getting a higher return, of course, because it bounces around more. Now, when we talk about risk, when we talk about volatility, there's some different measures that we can use. But one measure that's pretty standard is using standard deviation. So standard deviation is a measurement of the dispersion of returns. So that means what are each of the individual readouts we get across different years in this case, and how does that compare to the average return? So talk a little bit more about standard deviation just to give you an understanding of what it is. But the higher the standard deviation is, the more volatile an asset class is. Once again, we do want to make sure we look at long-term standard deviation for all of this, but that's really what we're measuring there. So think high standard deviation, and we'll talk about what it is, but high standard deviation means you're going to get a lot of volatility, a lot of one-year returns that are very different than that average return we get over the long term. But once again, there should be that relationship with, or risk, there should be a relationship with that return. So what does standard deviation mean? So what standard deviation is doing is, as I said, it's looking at that average return over a time period, then it's looking at each individual reading. So in this case, we're only going back 5 years. And it's looking at where do those individual readings fall compared to that average. And with standard deviations, if there's a normal distribution, we're getting a little into stats now, but if there's a normal distribution, we should be able to say with a fair amount of accuracy when we're looking over the long term, where we would expect returns to fall. So you'll hear a couple different terms. You'll hear one standard deviation. So one standard deviation occurs approximately 68% of the time in a normal distribution, meaning that 68% of the time, the return you receive on that asset class should be within one standard deviation on either side of that average. If we want to up that confidence level and we look at two standard deviations, that means it should happen 95% of the time. And this is where you hear these terms in investing called tail risk. So tail risk, if you think of a standard deviation or you think of a normal distribution, the tail risks are those outliers. And those outliers, when we're talking about two standard deviations, remember, we're talking about 5% of the time. So how do you actually measure this? So basically, when we say one standard deviation, we are taking that standard deviation measure, and I know this is a little technical, but bear with me. We're taking that standard deviation measure and we are adding it and we are subtracting it from that average return. And that's one standard deviation. Talk about two standard deviations. We are taking 2 times that standard deviation and adding it, subtracting it from the average return. So what this means is basically, if we look at this cash ETF, this beta shares ETF, that 68% of the time, the return should fall between 1.16% and 1.58%. So of course, I've added 0.21 to that 1.37. Same thing with 95%. I'm just adding double that. But then when we start looking at higher standard deviations, so when we're looking at this Vanguard Australian shares, all of a sudden we're adding a lot bigger number. So 14.28%. So once again, we're seeing 68% of the time should fall between a 24% return and some change and a negative 4.38%. When we get to 95%, you can see now the losses can get a lot larger, right? And those are those kind of outlier years we have where we see large losses, but we also can see very, very positive years as well. And that's the volatility that you need to contend with as an investor. And as we've said multiple times on these, volatility can cause you to make poor decisions because of either the euphoria you get, greed that you get when markets are really, really strong, and conversely, the fear you get when markets are really, really weak. That's how standard deviation works. And that's how we want to think about it as investors. And we just always want to consider, of course, that we are earning more of a return to deal with that volatility. So in some ways, it's natural. In some ways, it is the source of the higher returns you're getting. But of course, you mentally need to be able to deal with that. And that's why we want to look at those frameworks. So you understand what you're doing, you're understanding why this is actually happening. So we're going to use an example, and I've used her before. This is my friend Julia. So Julia does not work at Morningstar. I went to the cricket with her on Sunday. So Julia turned 30 last year. She actually just turned, I guess she turned 31 in December. So this is a little bit dated. But the way that a lot of us approach investing is kind of the way that Julia used to approach investing. So she has described herself as conservative. She had a goal that was not defined. So she wanted to invest for her retirement. She's a little bit conservative. So what does she actually do? Like anyone else, she is worried about losing money in the share market. We're all, of course, worried about losing money in the share market, but she wants to have a nice retirement. She kind of has this vision of having a nice retirement. So we're going to look through 2 different approaches. This risk tolerance approach, which is when you describe yourself with adjectives like conservative, right? What is the approach that people take with the risk tolerance approach? How much risk can I stand taking on versus a risk capacity approach where Julia is saying, okay, how much risk do I need to take on knowing that I want this retirement? And of course, the fact that Julia is 30 or 31 now means that she does have a long time period before her retirement. And when we're looking over those long time periods, of course, that's when volatility should matter to us less more. And instead, we should really concentrate on that level of returns that we're trying to get. So we'll start with her risk tolerance. Now, the way that risk tolerance is often measured is you fill out a questionnaire. And the questionnaire will basically ask you a bunch of questions about what would you do if your portfolio went down a certain amount. And what that's trying to gauge is, okay, well, we don't want to put you in a situation where your portfolio drops and you freak out and sell everything, all right? And that is a bad thing no matter what. So, Julia can go through and she can read these different answers that we have on here. And she can kind of pick one based on all sorts of things, like probably a lot of biases that she has and she's naturally developed, probably just this vision of how she sees herself as being a conservative investor. So maybe she goes in and she picks B. All right. So now she sees, okay, so we've got an average per year that the account's expected to grow, but she's really concentrating on that loss. So how would she handle that loss? Once again, we don't really think that this is the best way of approaching things, but Julia's gone through this exercise. She picked B, and she's really done it because she started looking at C and she thought a 20% loss, God, that sounds like a lot. That's certainly more than she wants to experience, so she picked B. Now, Julia has not in any way thought about her goal. She hasn't even defined her goal. She just said, hey, I'd like a nice retirement. I'd like to travel a lot. But she's never really defined that goal, and that's where she's running into this problem. The other approach, of course, is what we started talking about next Tuesday, where Julia's gone in and she's defined her goal. She looked at how much money she has. She tried to estimate how much money she needs for retirement. She thought about how much she can save. And all of a sudden, a minimum required rate of return popped out. What's connecting her from where she is to where she wants to be? And this is, of course, putting that context around her decision making. So she realizes she needs a 7.1% return now to achieve her goal. And this is, of course, going to allow her to now construct a portfolio that's actually designed to meet her goal, rather than being put in this preset risk tolerance based portfolio that's kind of based on what she thinks and how she thinks she may react to market losses. So what does this look like? Well, let's say, and we're going to talk about more asset classes here, but from a simplicity standpoint, we're going to pretend this is a 2 asset class world. And it's going to be those 2 asset classes that we looked at earlier, represented by those 2 ETFs. We've got Aussie shares and we've got cash. Now, obviously, once again, these are extremes, and we're looking at both sides of that risk spectrum, but it's really illustrative. This example is illustrative of the process she goes through. So she goes through this risk tolerance questionnaire. Remember, she's picked B. And so what this came up with is it gave her a 37% allocation to Aussie equity and a 63% allocation to cash. And the reason for that is because of projected returns. And we'll talk about the Morningstar projected returns. And these are them, by the way, for these 2 asset classes. We'll talk about the Morningstar projected returns for different asset classes in a second. But we're once again trying to define this portfolio that's going to give her that 4% that was on the B that she picked on the risk tolerance questionnaire, because we're trying to restrain that risk. And so in this 2 asset class world, we're looking at the expected returns and we're looking at the standard deviation, or the amount of risk that she's taking on, the dispersion around those returns that are possible, trying to get her a portfolio that may be a good one for someone who needs a 4% return by minimizing that risk at that level of return, but a portfolio that may not work. So remember, Julia went through this exercise of coming up with what she needs for retirement, how much she has now, how much she can save. So we can then put that into a portfolio projection, like the one we have on Morningstar Investor. And it turns out Julia had $1.17 million. Now that's great. She's a millionaire now. Good for her. But because she's defined her goal, all of a sudden we find out that she has really only achieved about half of what she's looking for in retirement. So that's not great. So what has Julia done? And if we remember that risk and return trade-off that we have here, what Julia's done is she has minimized, even though she's 31 years old, she has minimized that short-term volatility because she's worried about what that means. but she's also guaranteed the fact that she's not going to achieve her goals. Now, this is obviously illustrative. You wouldn't think that any 31-year-old would be in a portfolio that has a 37% allocation to equity and a 63% allocation to cash. But this also happens a lot. There are a lot of people that are very worried about taking on risk, and they gravitate to very safe assets without having that full picture. So even though I'm putting a little structure around this, still, there are a lot of people who will not invest in the share market, will not take on more risk, even though what they're doing, even though they don't have that goal defined, is they're almost guaranteeing themselves that they're not going to be able to hit that goal. And the last thing we want for Julia or for anyone else is to get her to a point where she's approaching her goal, in this case, approaching retirement, and all of a sudden she needs to take on a disproportionate amount of risk in order to try to get there. And that's really trying to catch up late in life. So whether that's catching up with an extreme savings rate, whether that's catching up by taking more risks, that can put you in a really bad position. Because while at 31, Julia should not care about volatility, if Julia is 2 or 3 years away from retirement, she needs to really care about volatility, right? Because she's trying to get to that goal. And if she has the misfortune of approaching retirement with really poor market conditions, she's going to be in a lot of trouble. The other side, of course, is she's using her required rate of return. She's taking more of a risk capacity focus, knowing she needs a 7.1% return. All of a sudden, this portfolio looks very, very different. So then to get that expected return, all of a sudden, Julia is 88% in Aussie equity and 12% in cash. So she's taken on her portfolio standard deviation. The expected standard deviation going forward is higher, but her return is actually going to meet her objectives over the long term. And all of a sudden she reaches her goal. So she's going to have to deal with short-term volatility. Now, hopefully it'll be easier for her to do that because she's gone through this process and she has this structure and framework around her decision-making. But she's going to have to deal with that short-term volatility in order to get that return. And hopefully knowing this and thinking about this is going to help her do that. All right, so let's talk about selecting your asset allocation. So Morningstar Investment Management is the part of our company that manages money. And what they've gone through is and they have set projected returns for different asset classes. And there's all sorts of inputs that go into this. So obviously what they're looking at is historically what have these different asset classes returned. But they're also looking at valuation levels because as we've said many times, and we'll talk about a little bit later when we get into opportunities, valuation levels are a key driver of future expected returns. The more expensive something is, the lower those future expected returns will be. And we'll pause and we'll spend a minute on this because volatility is a really important driver of those returns you get, but it's also the price that you pay. And if we think about returns and we think about, and as I've said many times on this and the podcast, we think about returns and the sources of returns. We worry about all sorts of stuff, right? We worry about what are central banks going to do. We worry about, of course, a company's earnings and the economy. We've got all this stuff we're worrying about over the short term. But over the long term, the price you pay for something matters. And the reason for that is because returns come from three places. As we recently talked about on the podcast, returns come from dividends. Returns come from earnings growth, because that's what investors will pay for, right? So the natural growth of the companies that you own, whether that's in an ETF, which is a basket of companies, or whether it's buying an individual company. And it returns from changes in valuation level. So if investors are willing to pay more for those assets, that's really good for you, all right? They'll add to returns. If they're willing to pay less, it's really bad for you. That's going to detract from returns. So if we have really high valuation levels, even if they don't fall, what that means is we're really removing that source of returns from the areas you're going to get them. So ideally, when we talk about as investors that we want to buy cheap, buy low, sell high, really, some of that return is going to come from those changes in valuation levels. So if you go back and you look at really since the GFC, but certainly more recently as well, not counting last year. We'll talk about last year in a second. If you look at performance of different asset classes, really the place you wanted to be invested was the US. So the US had significantly higher returns than we got in Australia. Higher returns than you would get with any benefit from a franking credit. And the valuation level in the US just kept going up and up and up and up. And the US market is a lot more expensive than the Australian market. Dividend yield on the US market is a lot lower than the Australian market. All these kind of future sources of returns. So while we benefited from that, if we're holding US shares, for example, if we benefit from that, we now need to take stock of where we are. So even with the losses last year, US market's about average valuation. Australian market's still a lot cheaper. And so our team, our investment management team, believes because of these differences in valuation level, that Australian shares do represent a better opportunity going forward for us because they're cheaper. Now, anything can happen. This is not set in stone. If the US market falls significantly and the Australian market continues to do okay, then all of a sudden the US can become a lot cheaper. And so when we say US shares make up a disproportionate amount, almost 70% of those global shares. So they've got a huge influence on that. And so what you can see is our projected returns for each one of these asset classes. That's what I used a couple slides previously to kind of design these portfolios. And then the standard deviation. So how much volatility does our investment management team expect? And remember, this is over the long term. So what this allows us to do is start to think about asset allocation and start to think about how asset allocation matters and how that's going to influence our overall returns. Now, with asset allocation, we, of course, don't want to sit there and look at these returns and put all of our money in Aussie shares, right? We still want that diversification benefit. And we still need to acknowledge, of course, that this is a projection of the future and anything can happen in the future. But at a very high level, when we look at growth assets versus defensive assets, it means we want to allocate more money into those growth assets if we need a higher return. We've gotten to the point where we need a lower return, or we're trying to do different things with our portfolio, dampen that volatility. Then, of course, that's going to shift our thinking around asset allocation. So I'll pause. We do have a couple questions. So Lisa says, does projected returns include stock value increases as well as dividends? Yes. So this is looking at total return. So that's a good question. Oh, then Lisa said I answered it. So Vidania is saying, Mark, what is the projected rate of return over the next 2 years for the asset classes of Aussie infrastructure? So we actually haven't broken out Aussie infrastructure. And the question specifically references Sydney Airport. Now, some interesting things have happened. If we look at sort of Aussie infrastructure right now, a lot of it's disappeared. So Sydney Airport was the example. Sydney Airport, of course, was previously publicly traded. It has now been purchased. What we've seen, particularly in the Aussie market, and I think some of this has to do with the currency weakness we've seen as well with the Aussie dollar, is we've seen a lot of consortiums of super funds and other institutional investors and private equity and things like that come in and buy a lot of infrastructure. And we've seen kind of this emphasis on infrastructure where a lot of people, a lot of investors believe it's a really good opportunity. They believe it's a good opportunity for a couple of reasons. Number one, what they're looking for and what you get out of a lot of infrastructure investments is you are getting that steady and easy to project cash flows, right, from things like that. So if we're talking about Sydney Airport, obviously, pandemic aside, when you start thinking about traffic volumes, you think about the other sources of income they have, whether that's parking or renting out stores and stuff like that, it's a lot easier to project that than some other asset classes. And what they've really liked and what a lot of these private investors have really gravitated towards is that, the predictability of those cash flows. And also the fact that a lot of infrastructure plays do have a sort of natural inflation hedge built into them. And a lot of these contracts that they have, whether it's Sydney Airport with airlines, et cetera, for gate fees and landing fees and everything else, has escalators in there for inflation. And we particularly seen this Well, we've particularly seen this recently that, there's this divergence, and we talked about this on our 2023 State of the Market podcast. There's this divergence of opinions about sort of what's happening. Are we in a quote unquote new normal where we've seen that relationship between monetary and fiscal stimulus, so low interest rates, governments pumping a lot of money into the economy? We've seen that traditional relationship reemerge between that and inflation, which we had not seen for all sorts of reasons. And listen to the podcast. We talked a lot about this. And some people saying we're going to go back to the way things used to be, where that relationship is once again severed, where we can have low interest rates and low inflation, where we can have a lot of fiscal stimulus from governments and low inflation. So there's a divergence of thoughts about sort of where we are, whether we're at an inflection period in the market. But what I would say is, the future fund, for example, in Australia is very much of the view that that traditional relationship is back, and we are going to have higher inflation than we become accustomed to really since the last inflationary period got broken in sort of the early to mid 80s. And so if you go in and you read sort of their thesis and the way that they've shifted their portfolio, and that's available, you can Google or email me Future Fund white paper. It's pretty short. It's like 3 pages where they just kind of outline some of the reasons why they think this is going to happen. They've emphasized investments like infrastructure, things that do have those built-in inflation hedges in there. All I would say is, of course, to get back to the original question, I went on a bit of a tangent. It's getting harder and harder to access Aussie infrastructure as this stuff gets bought up, right? And we've seen it in a couple different ways. We've seen it even with some of the sales that Telstra has done, where Telstra has unloaded some of their infrastructure, things like mobile phone towers, for example, that follow a lot of those same patterns. And we've seen them snapped up by private companies, and we've seen private investment groups. We've seen the same thing around energy generation. So some of those infrastructure plays are getting harder and harder to get in Australia. There are still some left. That was my very long-winded answer to your question. So sorry if that was a little too much information. So there's a couple other questions coming through. I'll move forward a little bit, and then I'll make sure I have time to get back there. So once again, we want to think about that structure around asset allocation. And next week on Tuesday, what we'll do is we'll do a portfolio review. So basically go through different steps that you can take to look at your portfolio, see how it's allocated, make adjustments if needed. But sort of today, we're talking about kind of that theory. Right? And that theory is we want to make sure as investors that we understand what we need, that return we need to achieve our goals, and then we need to structure a portfolio so that we can actually get those returns. And there's all sorts of surveys looking at this, but kind of famous survey that we always talk about at Morningstar, one by Ibbotson Associates, which actually turned into Morningstar Investment Management. So Roger Ibbotson was someone who's very focused on asset allocation. Our investment management group is still very focused on asset allocation, but they had a survey that came out a while ago, or a study that came out a while ago that said, about 90% of the variability of returns in your portfolio come from those asset allocation decisions. And that's why it's really important to focus on that and not just skip down to the security selection. And I get that that's the fun part, but get down to, as I was saying before, where you pick the individual shares and ETFs and everything else to go in your portfolio. That may be the fun part, but we want to do that with some structure, saying, okay, what are the different exposures that I want to get in my portfolio? So the mix between asset classes, but more importantly, that mix between defensive assets and growth assets, get that mix right. And then we can go out there and find securities that fit into those different buckets that we would like to have represented in our portfolio. So obviously, if there's more questions about asset allocation, ask them. We'll talk about it again next week. We're going to kind of shift gears into opportunities in the market. And we're going to take a little bit of a top-down approach. And we're trying to do two different things, of course, when we're finding securities. The first thing is, obviously, we're looking for those good opportunities. We want to go out there and we want to purchase, ideally, great companies at good prices, because we know that valuation over the long term is a big driver of how those individual things in your portfolio are going to perform. So first thing we want to do is kind of look at opportunities. And so what I'm going to reference right now, and I'll show it to you in a second, is I'm going to reference, of course, research that comes out of our analyst teams. But the other thing that's really important, and we'll spend some time talking about this, the thing that's important is to make sure that the investments that you put into your portfolio are right for you. And all of us are different. And even though it's really important, we do focus on risk capacity, within those large growth and defensive buckets, there are different investments that work for our overall strategy and what we're trying to achieve. And there are different investments that are just going to resonate with us. And the importance of that resonating, or those investments resonating with us, for us being bought into those investments, is, of course, the fact that what you want to do is hold those for the long term. You don't want volatility to impact you too much as an investor. So that can both be from an asset class level of making these big decisions about, how I'm going to set the asset allocation on my portfolio. But I also don't want to be sitting there and have that structure around asset allocation and be trading in and out of different securities all the time, because it just doesn't work. And a lot of that happens from investing in things that you are uncomfortable with and don't actually fit your temperament, and just that kind of intellectual framework that each of us have on what we're comfortable with. So we really want to focus on those individual investments, and we really want to make it very clear that whether we're talking about investment styles, or whether we're looking at value versus growth, whether we're looking at individual companies, we really want to make it clear that we're not all the same. And a great investment for your neighbor or mate or family member doesn't necessarily mean it's a great investment for you. You got to find things that resonate with you. I'm going to spend some time talking about this. So I'm going to do the always tricky, me trying to switch to another screen. But I do want to just highlight sort of the report that I have used as the basis for looking at some of these opportunities. And once again, for people that haven't seen this, you can, of course, email me and I will send it to you. But our equity analysts come out with in December and mid-December, I know December is a very busy time for a lot of people and maybe you're not that engaged, they do come out with a forecast for the year. And so at a high level, I'm going to reference this report, but it is worth a read. So it is 20 pages. So I'm not going to go through all of it. But really what this report looks at is it looks at a couple different things. So here it is, Your Money Weekly, the 15th of December, and I can send this to anyone who is interested. But what it's really looking at is looking at every single sector that our analysts cover, and is looking at where we see opportunity. So I'll skip ahead to we'll just pick healthcare. Just skip ahead to a random sector. And so what it's doing is going through in this kind of sector by sector approach. It's looking at the top picks that our analysts have within those sectors. And then also looking just kind of overall what the situation is with that sector. So I'll reference this at a high level. But once again, if you'd like that report, shoot me an email and I can get it to you. All right, so we'll go back into the PowerPoint. So what we're focused on initially, if we're going to look at a sector by sector review of the market, is we want to look at valuation. As I said, valuation levels are very, very important. We want to look for potentially where there's opportunities for us to go in and find things that, once again, are great companies trading at a reasonable price. So we've got two different charts on here, and I'll spend 30 seconds talking a little bit about the research approach that our analysts take, so this all makes sense to you. But as I said, one of the things that our analysts are very focused on is valuation. So what they're doing is they are calculating what we call the fair value on every one of the securities that they cover. And the fair value represents, of course, what they believe it's worth. And that allows us to very easily sit there and compare what we think a certain company is worth with, of course, what it's trading for. And that's the opportunity where we can see that value starting to emerge. So based on those valuation measures and based on how risky the company is, and we'll talk about that in a second, we come up with a star rating. So basically that's representing that price to fair value. 5-star stock being the cheapest ones in our universe, 1-star stock being the most expensive. And so you can see the distribution across every sector that we cover of 5-star to 1-star stocks. Once again, expensive or cheap, expensive, everything in between. So we consider a 3-star share fairly valued. And this is going to be one input we're going to look at. So if we look at some of the different sectors that we have, we can see two different things. We can see the current price to fair value ratio, and then we can see the price to fair value ratio a year ago. So when we're saying the price to fair value, all we are doing is dividing those two things, meaning that if we have a figure of 1, that means we think it's fairly valued. The price of that sector, and these are all the shares that we cover in there, in aggregate, what is the price of that sector? If it's around 1, we think in aggregate, all the shares in that sector are fairly valued. If it's below 1, then we're starting to see discounts. So basically, there's a price to fair value of 0.5. We would say in aggregate, the shares in that sector are trading for about half of what we think they're worth. So over 1, we of course think they're overvalued. So I just wanted to look at a couple different sectors on here. And you can see that, and this is all Australian shares. So the whole focus today is on Australian shares. We of course do this with global shares that we cover as well, but I wanted to focus on the local market, basically just to cut down the universe of things that we're looking at, and of course, because there's a lot more interest in the Aussie market here. So what we can see is the fair value, of course, could have changed over the course of the year, but at the same time, the price movements are going to drive that as well. So as different things happen, our analysts will adjust their models and will change that price, how much they think something's worth, or sorry, the fair value, how much they think something's worth, but that price is going to bounce around a lot. And if you think about what happened last year, there were certain sectors that did pretty well, certain sectors that have not done very well. Now in Australia, we've been protected by a fair amount of that volatility just by the makeup of the Aussie market. So what are the big companies that dominate the Australian market, the sectors that they are in, for example. And we've also been protected, of course, because the market did not reach the heights of something like the US market. So a couple different opportunities. One we'll talk about is energy. So you can see the two sectors, energy and technology, are both areas that are the cheapest, according to our analysts. Now, the interesting thing about the two of them is they did move in very different directions last year. So technology shares globally had a terrible year. Now, once again, this is where the Australian market's been insulated a little bit because there's simply less technology companies in Australia than in, for example, the US. So a lot of the falls in the US market have been driven by terrible performance by some of these technology companies, both kind of the large global leaders, whether that's Meta, just technically communication services, but whether that's Meta, Google or Alphabet, their parent company, which is also technically communication services. But Microsoft, Apple's had a poor year. We've seen a lot of really poor large companies. And we've seen really the bottom fall out for a lot of not large companies that didn't have earnings, don't have the strength of those companies. But we've seen technology perform really poorly. So even in Australia, where we have a smaller tech sector, we can see we went into the year a year ago where the sector was 9% overvalued, according to our analysts. And then because of that resulting huge fall, we got down to a point where right now they see it as 23% undervalued. Energy was very different. So energy got, if you remember, so we're talking oil and gas producers, for example, energy got hammered during COVID. Just because of, obviously, we're all moving around less. We weren't flying anywhere. Potentially, we weren't driving as many places. If you look at Australia, with state border, it's closed. And of course, with some cases, 5-mile radiuses of where we could go, you saw this worldwide drop in energy. and energy prices got really, really low. And then, of course, we saw a huge run up in energy prices last year. So one, obviously, is the economy opened up again and we started traveling again. And then also with what's going on with Russia and Ukraine and some of the disruption to supplies. But even though there was a huge run up and we saw that this price to fair value went up, our analysts still see a lot of opportunities in energy. So it's one of the things they talk a lot about in that report, and specifically go through what are our favorite of the Aussie traded energy companies. So something you can look at. We've also saw a really challenging year, if we keep moving up, in real estate. So of course, we're sort of inundated by a couple different things in real estate. Number one, this notion that, and we're talking, of course, now when we're talking about real estate, we're talking about listed real estate. So generally not residential, right? We're talking mall, office, things like that. And of course, we saw widespread concerns about real estate in terms of, is anyone ever going to come back to the office? Are we all going to shop online and not go to a mall anymore? And then, of course, we've had issues like, of course, interest rates going up, things like that. So you can certainly see that that is another sector that our analysts see opportunities. But as I said, I'm not going to go through the entire report because we are, of course, running out of time. But I did want to look at a couple different opportunities. So the first thing is our global best ideas. So basically, this is a list of all of our analysts' best ideas that comes out on a monthly basis. So this is the one that came out on the 1st of January. So we'll get a new one the 1st of February. What we do is we do best ideas from all over the world, but I'm concentrating on Australia today. And these are all the different opportunities. And I want to talk about some of the other ratings on here. And I want to talk about sort of how we can find securities that resonate with us. So we've talked about price to fair value. Of course, you can see price to fair value there. And that's one component, of course. So that's a really important component because valuation is important. But when we're starting to figure out what securities will resonate with us, we need to look at other factors, and we need to then start looking at the businesses. Because once again, you're of course buying a business, and we need to be clear that businesses are very, very different. And some businesses have more inherent risk associated with that business than others. So the simple example is, and we'll go into some specific ones, simple example is if we look at a giant multinational corporation that has a moat, so they have a sustainable competitive advantage, meaning that there are structural things in place that is holding competition at bay. That lowers business risk, of course. The different businesses, that large multinational ones, very different than a startup technology or biotech business, right? They're inherently different businesses. And the business risk associated with the two of them is very, very different. Now, that startup tech or biotech company, of course, with that high risk can come a very high reward, right? So if they make it, turn into one of these giant companies, of course, you're going to be very well compensated for that. They could also go out of business, and they could also flounder. We're not going to get as much of that risk with these giant multinational companies. And a lot of this is captured in two different ratings that our analysts come up with. So the moat rating, as I had described previously, right? If you have an economic moat, it holds competitors at bay, that lowers business risk. And then a lot of it's captured in this uncertainty rating. And the uncertainty rating is really our analysts looking at, okay, what are all the factors that are impacting this business? And I will use two examples in a second. So it's something else that's important to look at. So personally, and this is not telling anyone what to do, I'm generally attracted to companies that have lower uncertainty. So I'm looking for ratings like a medium uncertainty. Of course, I want to study the business myself, but if I'm just scanning down this list, I'm looking for more of the mediums. There's no lows on here, but lows another rating, as opposed to very high. And actually our top rating, the most uncertain, is extreme. And the way that we compensate for these different, the business risk associated with, so the business risk can be the line of business they're in, it can be the debt levels that they have, having a lot of debt increases your business risk. And I'm sort of looking for, because of what I'm comfortable with, medium and low. whereas other people may gravitate towards some of those higher risk companies. And the way we compensate for this is the margin of safety, or how big of a difference between the fair value of what we're trading it for and where we would actually buy it, right? So we have larger bands, larger margins of safety that we recommend people take with those very, very uncertain companies. Because frankly, anyone, our analysts who spend a lot of time studying that, anyone else, because there's so many different factors that could impact the outcomes of that business, since that's what you're buying, whether it's a good year or a terrible year, or they go out of business eventually. Yeah, we want to demand a bigger margin of safety there. So those are some of the things that you can look at. And then, of course, go in and study the companies more. And even like indicators, like does the company pay a dividend, for example? That's an indicator of the business, right? Dividend, of course, is a choice by a company. When do boards make decisions about dividends, to pay a dividend in the first place, to raise that dividend? Well, they're looking at, okay, is this safe to do? And so generally, larger, more mature, established companies are the ones that are going to pay dividends. You can look at dividends, for example, as well. You can look at debt levels, because debt can obviously influence the range of outcomes possible for a company. So there's all sorts of things we can look at, but I didn't want to go through that as an example. Now, I pulled two names off of this list. So over here on the left is InvoCare, and this is Kogan. And both cases, they are on the list. So both of these are on here, but this is really about figuring out, okay, what's the best opportunity for you? So we can briefly talk about these. And we'll start with InvoCare. And you can see InvoCare, I pulled this represents last night, 27% discount to our fair value. So you can see our analyst Angus thinks it's worth $15.30. Closed last night at $11.19. It has a wide economic moat. So we do think that there are factors in play, and we're not going to spend too much time on moats today, but we do think there are factors in play that pull competitors off. And medium uncertainty. So sort of Angus's viewpoint of what's going to happen in the future, and sort of his ability to estimate what InvoCare will do in the future, has a lower uncertainty level than Kogan, which is very high. So even though Kogan is trading at a larger discount, 57%, it does not have an economic moat, has that high uncertainty. If we think about the businesses, this will start to become clear. So what does InvoCare do? So InvoCare runs funeral homes. And, at the end of the day, when you look at funeral homes, there is more predictability about what's going to happen in the future, because while death rates do vary year by year, over the long term, they're pretty easy to predict. So it's pretty easy to predict how many people are going to die. So that's a good thing, because not a good thing if you die, but it's a good thing when we start looking at companies. We also want to look at how the economy may impact a company like InvoCare, because the economic uncertainty, the environment particularly that we're going into, where there's more economic uncertainty, is going to be a factor as well. Because of course, the way the economy goes is going to influence how certain companies go. Well, InvoCare has a couple things going on. Number one, we talked about sort of long-term death rates and how they don't vary that much, and they're pretty predictable. The other thing is, in general, when somebody dies, there's less cost consciousness around that funeral. It's often paid out by the estate, for one thing. It's not a time where a lot of people are thinking about cutting corners for their relative's funeral. Also, around 10% of InvoCare's funerals are prepaid. So those are, of course, those programs where you prepay the funeral. So that gives them line of sight into those earnings they're going to get, and it also provides some safety if there are fluctuations in the death rate. We did see a fluctuation in death rate. I think it's been publicized a lot during COVID, for example. And then if we flip over and we look at Kogan, so Kogan we don't believe has a moat. So it's obviously involved in online retail. There's a lot of competitors. There is very little that stops consumers from deciding where they're going to buy something, whether it's Kogan or Amazon or anywhere else. People will generally shop around And so we just think that there's a lot more uncertainty there. And while there are some positive things, including the shift onto more and more online spend that we saw accelerate during COVID, we do believe that there is a lot of uncertainty about sort of earnings predictability going forward. And you've seen brands try to, and Amazon, for an example, who does a good job of this, we've seen online retailers try to figure out ways to drive more loyalty. So Amazon, of course, the famous way they've done that is through Prime, and really, the membership service that they have, which is a lot bigger thing in the U.S., which is a big market for theirs than it is in Australia. And we've seen Kogan try to replicate that as well, but just haven't really been able to do that in our analyst opinion. So while our analysts really like Kogan, while they think it's cheap, while they think a lot of the sort of worries, and if you look at what happened with Kogan, did very well beginning of COVID and then has done very poorly. We think a lot of that's overblown. Still, it is a place where we think there's a lot more uncertainty about the outcome, where maybe Kogan will do a fantastic job and really pay off for investors. Maybe all these competitive pressures and all the things that they face just by the industry that they're in will cause them not to do well in the future, right? It's that range of outcomes. All right, so I've realized somehow this hour disappeared very quickly. Let me go through and start answering some questions that we have here. So please give some examples of Aussie listed property. Oh, I mean, there's a lot of them. So what I would do is, so everything from what, now of course I have to think of them. So everything from CIMIC to Lend-Lease. Charter Hall has a bunch of different vehicles you can get into. So those are all big examples, but yeah, there's a lot. If you want to send me a list, or send me an email, Pravesh, I can send you just sort of our coverage universe and Aussie listed property. So Lisa says, do the basic types of asset allocation ever evolve? Have we seen changes in the way large investment firms allocate? Yeah, we absolutely have. So, what I would say from a large investment firm standpoint, there has been a lot more allocation to private investment. So whether that is private equity, whether that's venture capital, whether that's certainly direct ownership of things like property. We've seen a lot of that from super funds. Certainly things like timber. Yeah, we've seen a lot of evolution. Really, there's been this sort of Yale endowment model that focuses a lot more on sort of non-publicly traded asset classes. So we have seen that evolution into infrastructure, things like that. Whereas, you go back a while ago, it used to be sort of shares and bonds, right? And so we have seen that evolution. Now, I would still call those at a high level, those are also growth assets. It's just kind of how you're going out and accessing those assets. A question from the anonymous attendee. Hi, what's your view on Magellan now that we saw $5 billion in outflows in the last 2 months? So listen, what I say about Magellan's obviously had a horrible year in 2022. It is still on that list. So, Sean, who is our analyst that covers Magellan, and has some recent research updates and articles about it as well, still does see it as attractive, basically given how much it's fallen. So our analysts still do have a positive view on Magellan. Magellan, I think from an uncertainty standpoint, I believe, we go back here, it's on here. So Magellan, very high. So listen, it's something I would invest in, probably not, but I think certainly you go through and read Sean's research report, and there is still, he still does have a positive view. Nope, I clicked on the wrong thing. There we go. All right, so we do have a question from George. How do you view Aussie uranium miners? We don't cover a lot of them. So I cannot introduce views that are on shares that our analysts do not cover. I will say we don't really cover a lot of the large Aussie uranium. It's something that there's been a lot of interest, obviously, with the thought that increases of electric vehicles are going to drive battery production. Big ingredient in battery production is lithium. All I would say is, for a lot of these kind of basic materials, miners, uranium and otherwise, it's obviously very much looking at supply and demand. And often you have demand-driven increases in production that then get ahead of themselves where, okay, now we have too much supply. But I know obviously the uranium story is one that we're looking at. So Mark's saying, how do you reconcile current recommendation market view with an old valuation date? For example, the IVC data valuation, 15th of April, 2020. Yeah, I'll have to go back and check that date. I know that it says it on there. Let me go back there and check that date for you, Mark. Our analysts, so whether that date is right or not, which would be a problem if it's not, our analysts do sort of constantly look at every company they cover. So they do have continuous coverage of these companies. Now, they will only update that valuation if they believe there is a reason to update it. And I personally own InvoCare, so I don't think the fair value has changed in a while, but I can check that. Yeah, so Rodney's saying, and Happy New Year, Rodney. He's saying the last update was December 2022. So they'll continually update their reports. Whether that changes that valuation level or not, it's based on market conditions. Sorry, we seem to have hit 2 o'clock. There are some people saying that they're interested in the report. We do have a question that I'll try to answer, so just email me for the report. Andrew's saying, what are your thoughts on gold as an asset class to reduce volatility? Yeah, gold's an interesting one. So we do not cover gold at Morningstar. We do cover gold miners, but we don't cover it as a pure asset class. Gold has always been something where there's been a little bit of a flight to quality during times of geopolitical, economic, everything else stress. A lot of people have moved to gold. My kind of concern with gold, if you go back, gold's kind of performed as inflation has. If you go back thousands of years, and there's studies where they look at what Roman soldiers were paid in gold and compared them to modern soldiers, it's kind of tracked inflation. Over the long term, there are people that are certainly very interested in gold. But we don't have a view on it at Morningstar. All right, so we're at 2 o'clock. I'm sorry, ran over. But as I said, I'll be back doing this again on Tuesday. We also have one the next week after that on the 31st. We're doing one at night, which maybe will be a little easier for people to tune into. But anyway, thank you guys for joining. Shoot me an email if you have any questions or want that report. It is mark.lamonica1@morningstar.com. It's the email address that's in the invite and the reminders that you should have gotten for this. So thank you guys very much.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.